Next up, we have arguably the most stacked panel of the entire trading festival. We have 4 expert panelists who will be discussing some of the big sector moves this year, led by someone who will be a familiar face to everyone who subscribes to the SGX mailing list or watches financial news media in Singapore. He's the SGX market strategist. Please welcome Mr. Geoff Howie.
Thanks very much, Edward. Really looking forward to this session. We'll run for the full hour, looking at the big sector moves since 2022 has begun a quarter ago. What I'd like to do quickly is to introduce my fellow panelists. We've got Adrian Lowe. Can't see Adrian's face just yet, but I'm sure we will very soon. He is the head of research for UOB Kay Hian. He covers Singapore energy and industrials, as well as property developer sectors, and of course Singapore strategy, while maintaining a team of 10 analysts. And he has operated for, I think, for close to 25 years in both the buy and sell side of capital markets, really specializing in the energy industry. We've got Paul Chu next along there, who is the head of research at Phillip Securities. He has 20 years of experience as both a fund manager and a sell side analyst. He is known in the industry for his competence in analysing companies, industries, and countries with a very good in-depth understanding of the working and dynamics in equity markets and, of course, the asset allocation process. And we've got Thilan, who's the head of research and head of regional financials at MIBG Singapore, where he provides active equity research coverage of Singapore financials and commodity supply chain players, as well as the Singapore market and ASEAN financials investment strategy. He is also the co-founder of Create Lab, which is regional edutech startup, and also has, the preceding 2 speakers, also at least 20 years experience working across big institutions and global brokerages, as well as we've got, of course, Weiren, who serves as the senior portfolio manager at iFast, where he oversees the firm's asset allocation decisions and the investment management process. He also heads the iFast research team, which is responsible for investment research and analysis across asset classes, investment strategies, and of course geographical regions. So we've got an absolute wealth of experience here on this panel. So hopefully I haven't really given them justice in going through their full bios, but that's just a quick flavour of the experience that we've got. I'd like to also get a little bit more background on each of the speakers. So I would like to ask them about the key sectors that they each cover. But just for a preface, and very much to continue on from Darryl's presentation, in the first quarter of this year, the STI was Asia Pacific's strongest benchmark. It generated a 9.5% total return. Interestingly, the Jakarta Composite Index, the Stock Exchange of Thailand SET Index, the FTSE Malaysia Bursa KLCI Index were also among the top 5 performing Asia Pacific benchmarks for the quarter. And an interesting takeaway for March was that there was less dispersion across the sector returns within the STI than we've seen in many months. Thus, a lot more of the gains were broad-based. So it would be great now just to, I guess, touch on some of these important sectors. And Adrian, we've got you. Have we got Adrian? Adrian still connected? Okay. Yep. Well, I can see you, Adrian. We're going to maybe start with Adrian. If Adrian could talk a little bit about Singapore real estate, urbanisation plays, and so forth. Just what's really hot, or if you could just give us a couple of minutes, Adrian, on what's happening in your side of the stock market that you cover.
I guess for the property sector, clearly, the key thing that has beset the industry is price rises, and I think that's gradually crowding out the middle class. But so the government has come in with some cooling measures to try to control those price increases. So Friday's release of the property price index numbers, it will appear that the tightening measures have dampened some of that demand. But largely, investors are really focusing on companies like CapitaLand Investments that have that ability to grow their return on equity over the next few years. Obviously, they're engaged in various property sectors across in Singapore, as well as in the region and globally via Ascot Residential Trust.
Fantastic. Thank you, Paul. Consumer sectors, telecommunications, the health sector, and so forth. I know that you're quite articulate there. Is there much happening in those three sectors at the moment that you think's worth highlighting?
I guess the specifics for each sector would be, for consumer in general, would be the reopening. I think last year there was so many closures, so you get a boost there. Of course, raw materials will be the other issue, but I guess the value now is that if you have a brand, I guess that's very valuable when you have inflation right now. For telcos, it's about roaming, and probably that would be that is actually a huge part of profits, as much as even 50% of profits. So that would be another boost. For electronics, we think this year will still be strong. Maybe next year will be the issue. Yeah, that's to give you a flavor, I think. Yeah.
Yeah, that is a good flavour. Thilan, how about financials? How are they looking at the moment? Banks started off the year pretty strong. Has that momentum continued? Has it continued through the quarter, do you think?
I think so. I mean, if you look at the sector, UOB is up nearly 20%, DBS, OCBC up around 8%. And I think what's interesting is this is despite the fact that they've actually missed fourth quarter expectations largely. So I mean, I think the market is looking ahead for stronger earnings to come through. I think the Fed rate hikes are definitely going to help in terms of better interest income coming through. And remember, these are banks that have optimized their balance sheets post the global financial crisis, post 2009. For low interest rate environments. So as interest rates rise, you're going to see a lot more operating leverage coming through. And I think also on the non-interest income side, the sort of volatility that you're seeing globally will drive a lot more demand for wealth preservation. So I think the wealth management sides should actually come in quite strongly as well. Plus the regional reopening. These are banks which are very well integrated to ASEAN as well as North Asia. So you should see better earnings, better loan growth coming through. I think one of the areas that I'm a little bit concerned about is actually costs. We are in a high inflationary environment, and we've seen, particularly for Singapore, the staff cost side is rising, given the sort of stricter foreign employee quotas and things like that. So that's something to watch out for, as well as IT costs as well. That's rising. On the asset quality side, I'm generally a lot more optimistic. I think that'll come in fairly benign, but I don't see the banks, falling over themselves to release their provisions that they have taken over the last few years, given the sort of global uncertainty there is. But yeah, so I think to answer your question, we are still looking for improved momentum in terms of earnings coming through for the rest of the year. We're looking at about 18% sort of earnings growth for the Singapore banks, and also better prospects for dividends as well.
Weiren, to just take a broader perspective, looking at the stock market, I guess, could you basically give us some of your thoughts on the role of stocks in a portfolio at this time, or what you're also seeing in terms of stocks being basically in demand from investors, or the impact of fixed income as well, and the moves that the fixed income markets had. If you've got, can you just sort of offer us a little bit of a broad perspective on the appetite for investing in stocks at the moment, based on all these very dynamic, different sector drivers that your fellow panelists have just shared?
Yeah, sure. I think every asset class has a unique role to play in our portfolios. So if you're talking about stocks, their role historically has always been to provide investors with long-term capital appreciation, which is not surprising, because stocks, they have historically delivered the highest return across all asset classes. And then you have certain kinds of stocks that not only give you capital appreciation, but also a regular stream of income as well, such as your dividend stocks and REITs. And in this kind of environment, from what I'm seeing, based on what our investors are buying, stocks continue to be something that is relatively interesting. They feature very prominently in the portfolios of our investors. But I just wanted to say that traditionally, when you talk about deciding which asset class to invest in, investors, they tend to allocate more capital into stocks compared to other kinds of asset classes, because the decision is always skewed towards considerations like, what's the kind of return that I can potentially get from this asset class. And stocks is usually the one that shines compared to other asset classes, because investors, they want to invest in the thing that gives them the highest return. But other things like downside protection, portfolio stability, or even inflation protection, these are themes that are increasingly relevant in our current environment, but I think investors are not putting enough focus on these areas. So that's where asset classes like fixed income, commodities comes into the picture, and I think having different asset classes in your portfolio allows you to enjoy the benefits of diversification.
It's really interesting that you see the investors, I guess, at that particular mindset or with that outlook, because last 2 years, the market really had one big overarching driver. That was COVID-19, obviously, and all the containment measures and the impact it had socially and economically. And then towards the end of last year, we did see the reopening theme start to make its effect with some of the repricing of airlines, hospitality, food services, consumer cyclicals, and so forth. But this year has been just so much more dynamic. And hence, investors might want to have a little bit more appreciation across all the various sub-drivers that make up these sectors. And I mean, as you said, that as everyone has said, really, that we've got these key drivers at the present, which are inflation plus supply chains having this pressure. So really, globally, the big two drivers have been spiking energy costs, as well as container shipping rates and so forth, still at 6 times the price they were pre-COVID, plus the staff costs, rising wage costs, particularly for trade-focused economies such as Singapore. Then you have the Ukraine crisis, and then we have the ongoing Deltacron. So given there's no overarching theme this year like we have last year, those other sub-drivers like ASEAN resilience, digitalization, the different valuation and business cycles of the structures, as well as, of course, the big corporate restructuring, are having much impact across the key sectors. So our biggest key sector, of course, is the banks. Banks globally make up around 8% maybe of total market capitalization. But in Singapore, they make up 20% of our total market cap, and they make up actually more than 40% of the STI. So Thilan, could we go back to you just on, you gave us a rundown on the key banking factors that I guess really are the sub-drivers, but is there one or two in particular that you're focused on for the immediate outlook? Basically, the outlook for US rates has really had an impact on their performance, given the correlation of net interest margins with US interest rates. However, what other factors do you think might take into account some of the outperformance we've seen? As you said, UOB is up 20%, and as Weiren also said, that there are a multitude of factors now driving these different sectors. Is there any couple of more points on the bank you might want to elaborate more on, Thilan?
Yeah, so I mean, if you look at the Sing Bank's performance, right, they've outperformed the US banks, the European banks, the Chinese banks this year. And I think, while the sort of conversation is concentrated around the sort of interest rate hikes, I don't think that's the only driver. I think the fact is the Singapore banks offer a lot more earning certainty and also a lot more competitive moats in this sort of environment. If you look at the US and European banks, largely, there's a very large trading and capital markets related component in their earnings, right? In some cases in the US and European banks, around 50% of their earnings actually come from capital market related sources. And this is very different to the Singapore banks. The Singapore banks are very much, interest income driven, very traditional businesses. So I think that gives them a lot more earning certainty than some of the global banks. And I think also a lot of the global banks are a lot more closer, and you just mentioned this as well, to the Russia-Ukraine conflict. And also, I think some of the slowdown that you might expect to see in some of the developed markets. And And this is in contrast to what the Sing banks have, which is they're much more regionally integrated into ASEAN. And we're starting to see ASEAN opening up. And this will create a lot more opportunities. They have actually been investing significantly in the sort of regional flows and the north-south flows into ASEAN. So I think that'll also benefit them. And I think on the flip side is the fact that you've got very, very strong capital ratios going into this year. As I said earlier as well, I think there is still a lot of uncertainty. I think that's what this year is characterized, and I think there's a lot more comfort for investors when they look at banks that have very strong capital ratios. All three have CET1 ratios over 14%, provisioning covers over 100%. So I think that also gives a lot more flexibility for these banks to put in a little bit more risk if they want to, and also pay a little bit more dividends if they want to as well, which I think some of the global banks might not be able to do as easily.
It's a good point. Just a reminder too, if for all our investors, DBS actually does go ex-dividend on Friday. I think it's a 36-cent per share dividend. So the accommodative monetary policies are not the be-all and end-all, obviously, and there's been a lot of other economic policies at work. And now we have this, I guess, earlier than expected withdrawal of accommodative monetary policies over a number of countries across the globe, obviously not every country, but for the West and for Singapore as well. Weiren, could I ask you how that earlier than expected withdrawal of these accommodative monetary policies across the globe, do you think they've influenced how iFast has been allocating its clients' monies?
We have been diversifying our clients' portfolios. And we have also been shifting these portfolios towards parts of the market that can potentially outperform in an environment of higher interest rates. So one of the things that we have done is to initiate exposure into value stocks. So growth stocks, they have done well over the past few years, but I would say that's largely because of the ultra easy monetary policies that are implemented across the world. So in the past decade, you'll see that low interest rates can just about justify any valuation for stocks. It doesn't matter whether a company is profitable or not. As long as it has a good story to tell, I think investors are pretty much willing to pay up for that particular stock. But I think with this potential change in the interest rate regime, I think the next decade could look very different from the past decade. And with investors also now being more disciplined when it comes to stock valuations. So I think there is this possibility that the value outperformance that we have seen in recent times, this could sustain in the years ahead. But in our minds, the debate is not so much about whether growth stocks is better or value stocks is better. So for us, from a portfolio perspective, it is more about the concentration risk we have in growth stocks. So I think we have been going into tech stocks over the years, but we relooked our exposure and we thought that initiating exposure into value could provide some diversification for our clients. So at the sectoral level as well, I think financials, that's looking interesting. And what Thilan has just mentioned, I think it is a good dividend play, not just in Singapore, but at the global level as well. And energy, material sectors, these are excellent dividend plays as well.
It's very interesting from the investor perspective. If I could just switch to the consumer perspective quickly to bring Paul into the conversation. Paul, Deltacron, it saw global COVID-19 cases back on the rise for the beginning of March, actually most of March. But by the end of March, those smooth gauges of daily COVID-19 cases did return to comparable levels at the end of February at around 1.5 million global cases a day. So how is this progress that we're making in working with the endemic impacting the consumer sector, you think, as well as, I guess, not just consumer sector, but possibly adjacent sectors that have become interesting to investors, as Weiren was saying, providing a little bit more higher beta or potential growth potential since we've been making this progress with the COVID-19? And do you think companies are still possibly remaining, I guess, a little bit more cautious than the investors or the consumers with the outlook of potential new subvariants and so forth?
Thanks, Geoff. So for consumer, it's pretty wide. So let me just focus on consumer staples, which I believe Thai beverage should also be considered a consumer staple. Anyway, for this year, it will be all about the impact of reopening. So this will be the key theme for 2022. Last year, there was multiple shutdowns. Sadly, the entertainment outlets in Thailand were shut down, for instance, and also you had Vietnam also had some shutdowns in the middle of the year. So this year, you get that the immediate benefit of reopening, and in addition to that, you also get the general economic uplift of conditions. So that will be the main theme for this year. The second key theme for consumers will be, as mentioned earlier, will be the rise in raw materials. You can name it. You can ask any consumer company, they just tell you everything is up. No, sugar is up 30, aluminium 50, tin is almost 60, 70. So the key right now is the strength of the brand and the ability to pass it on. Those that are based here in Singapore, they should be, or they better be able to pass it on, because their market shares are as much as 90%. For Del Monte or Thai brand. So that's what we are looking at, and these will be the two key themes. In terms of just one last part, in terms of cautiousness, they were cautious in maybe 2020, 2021, where they really bludgeoned costs, especially A&P. So I think right now you will see that climbing back up, but that shouldn't materially impact profits. Yeah.
Okay. Another key sector, apart from consumer cyclicals and beverages, of course, is the real estate sector. And on Friday, we had our flash estimate for the first quarter that Adrian just mentioned for the Urban Redevelopment Authority Property Price Index by residential type, which grew 0.4% or 0.4% quarter on quarter, which actually did represent, I think, the slowest growth rate since the second quarter of 2020. And it did follow a 10.6% year-on-year gain for that index in 2021. I think for the week, we had city developments up 2%. UOL was down 0.1%. Fraser Properties was up 3.7%. So quite a mixed week for the developers as well that week. So, Adrian, if I may ask you, how do you see those recent tightening measures, even the ones introduced as late as what was it? Oh, almost. Where are we now? It was a long time ago, 6 weeks ago, the budget on the 18th of Feb. How do you see those recent tightening measures introduced on the 18th of Feb possibly impacting the real estate sector this year? And I guess offsetting that potential above trend economic growth that we are still expected to see this year do you have a prognosis for our real estate outlook?
Based on Friday's release of the PPI residential index number, it would appear that obviously the tightening measures have dampened demand, given that the fourth quarter saw an increase of 5% quarter on quarter. So looking more closely at some of the numbers, we saw core central region and the rest of central region declining in the first quarter versus growth in the previous quarter. And the only region that had growth was the outside central region, albeit at a significantly slower pace of about 2% versus nearly 6% in 4Q. So as you said, while economic growth is forecast to be pretty strong this year, and the MTI is forecasting a range of 3 to 5%, and that's normally a positive indicator of strength in the property market. We would focus more on a couple of interesting data points that we want to point out. So firstly, the units of unsold private residential inventory is at multi-year lows, just over 14,000 units. At the height, they were sort of 50, 60, 70,000 units. And secondly, this estimated number of HDB flats that are reaching their minimum 5-year minimum occupation period will hit a multi-year high of 31,000 units this year. So what we're seeing is that this points to demand for both private and public housing to remain relatively firm, especially for the first home buyers. So while some demand is taken off the table due to the higher stamp duties that we're seeing, the taxes that are targeted at the wealthier end of the property market, first-time home buyers are not affected, and this is where demand we think should remain firm. So I think coming to the stock level, we think Propnex is a very direct play on the Singapore residential market. Share price has done very well. APEC Realty, we don't cover that, but obviously again, just looking at the numbers, the share price has done very well too. And on a more regional and global basis, obviously, we continue to like CityDev and CapitaLand Investments.
What about the other drivers, I guess, of the big sector? You mentioned Propnex and so forth, which had a stellar year last year in terms of its performance. But what about beyond the macro and the launches and the sales and so forth? What about beyond that? We've seen a number of companies engage strategic initiatives to either pivot, repivot, or restructure their business to add shareholder values. Could you maybe give us a little bit of an update on those developments, which do continue to see momentum, which we've seen really grow over the last 2 years, such as CapitaLand having its very important restructure. We've got Keppel 2030. We've got Sembcorp Industries looking to make its sustainable solutions portfolio a much bigger part of its net profit in the coming years. What's your thoughts on this being a key driver for investors to follow as well, the more micro side of the market, Adrian?
Yeah, good question, Geoff. The big sector leaders have engaged in restructuring over the past few years, partially as a result of the need to allocate capital more efficiently, as well as to take into account higher levels of corporate responsibility, especially on the environmental front. So one can see the demerger of CapitaLand's property development arm as being an effort to remove a business unit that required a lot of patient capital that only saw returns 3 to 5 to 8, even 8 years later. So with the new business entity in the form of CLI, there's now this business that is more asset-light, can generate much higher returns on capital employed. And the expectation is that the company will continue to increase its asset-light business relative to its more asset-heavy investment property business. And just recently you saw, it sold its 79 Robinson Road asset to a related party. For Keppel, I guess, its Vision 2030 strategy was very much born out of the identification of long-term mega trends, such as urbanization, energy transition, and technology proliferation, to name 3. Through its asset management segment, the company plans to bridge and connect all its business segments, and thus more efficiently deploy capital across the whole group, rather than just very, very much silo sort of a mentality. So while the potential upcoming sale of its offshore marine segment is jettisoning an asset-heavy business, Keppel will naturally still retain its asset-heavy property business that still has substantial land banks in China and Vietnam. And last but not least, obviously, one of the major restructurings that the market has seen is the Sembcorp Group, right? For SCI, the company is going green, mostly because it has to, as a decent proportion of its power production is coal-fired in nature. So we've really seen major institutional investors become a lot more sensitive to companies that are not ESG compliant, and financial institutions even declining to lend to coal producers, for example. So to be fair, the company has made very strong strides in getting more renewables under its belt in the past few years. And with its new CEO, Wong Kim Yin, I think SCI definitely has had to properly enunciate its desire to more forcefully become a green energy company and move away from fossil fuels over time. So we'll gradually see that over the next 6 to 12 months, I think.
Thanks, Adrian. Paul, I think if I could ask you, we've covered the green economy theme, which has been very important to the financial markets, but so is digitalization, not just in Singapore but across the region. Paul, could I ask you, in terms of the impact digitalization is having to the telecommunication stocks and other mega sector, how have, for instance, Singtel, StarHub, strategically address this? I know there's the initiatives such as the Dare Plus for StarHub, and then some of the pivot of NCS, the traditional NCS business to digitalization. Do you see digitalization as being a big disruptor to telco stocks, Paul?
Okay, yeah, thanks, Geoff. Over the past 20 years, you could actually say digitalization hasn't been kind to the telcos. When 2G was up, we had 2G, so that was fun. No penetration 0 to 100 plus now. Then 3G was even more fun. You can sell SMS, mobile IDD. So 4G, if you assume 4G is the real digitalization, then they got badly hit and they missed the whole app trend. And 5G, we don't really see that much changing. So from 2G to 5G, they're still selling, data plans, voice plans, maybe in a cheap handset. So digitalization has been a bit brutal for the telcos. Digitalization now, it's mainly more to cut costs rather than grow revenue. So that is the challenge. And ironically, despite owning the toll road or infrastructure and access, they could not capture the value, like Apple Store. Apple Store controls that. You could assume that the App Store is like a toll gate, but somehow the telcos couldn't transition that. So digitalization now is just cut costs for now. Yeah.
Yeah, it might be pretty similar for a number of other sectors as well. Not so much from a competition foundation, but more as a complementary way to reach customers and so forth. How about the banks, Thilan? Do you see digitalization as a key driver for the banks as well? Particularly, as you said, there's a strong ASEAN focus with our banks. There's a strong ASEAN focus with digitalization as one of the five core economic drivers, I think, going forward. And you might want to kind of, if you want to touch on tokenization, is that potentially providing still more opportunities than challenges? And there's a question too from Patrick Chiang. Patrick is asking, how do you invest in the digital banks and the distributed finance trend? Maybe you can touch on that if possible as well. But the question really is all about digitalization and the impact it's having on the banks, particularly our banks, Thilan.
I'll get to Patrick's question right at the end. But
okay.
I mean, one of the interesting things that I came across during the management briefings for the fourth quarter was UOB said that 20% of their customers are digitally engaged. What that means is that they're performing transactions online that is actually helping the bank to save costs or avoid costs. And I think that's actually a very, very strong sort of indicator of where digitalization is going. So, you're already starting to see the fruits of digitalization being reaped by the Singapore banks. And I think COVID-19 has also kind of permanently changed how customers interact with their banks. More and more are going digital, and that I think is here to stay. Now, if you have banks that don't actually respond to this by upgrading their digital infrastructure and also offering hyper-personalized products, I think they're going to lose market share, and they're also going to lose earnings as well. So, when we talk about digitalization, there's always this argument that the digital banks will come in and eat the traditional banks' lunch. And I think in Southeast Asia, and particularly in Singapore's case, this is not really what's going to happen. I think, the banks themselves already have very strong digital infrastructure. The Singapore banks are probably second to some of the US and European banks in terms of their tech spend. And I think, what will happen eventually is that digitalization will actually increase the addressable market for banking services. Now, what I mean is, in the past, and you have very large underbanked populations in Southeast Asia, particularly Indonesia, Thailand, Vietnam, where it was very expensive to acquire these clients. Now, with digitalization, the client acquisition costs, the customer acquisition costs are falling. So that's actually increasing the addressable market. And I think that's where a lot of these banks that have been spending money in their digital infrastructure will start to win. Now, you talked about, you asked me about tokenization, and I think this is really where the tokenization will come to help. I am not particularly a believer that in the current form of tokenization, it's going to cut out the middleman. I think there is significant issues with security, with latency, with regulatory, changes that it's going to happen in the near term. But I think what tokenization does, it enables more assets to be liquid. And it actually brings more assets, and it also provides ownership provenance of assets. And that actually will help a lot of markets in the region, Indonesia, Vietnam, Thailand, where proving ownership of assets is actually quite difficult, whether it's owning land or any sort of other sort asset. So this will actually help with financial inclusivity. And I think that's an area where the banks will actually play a significant role. We're already starting to see banks like DBS investing in crypto infrastructure, and a lot of the other banks are also investing in this. So I think tokenization particularly will be complementary to the banking sector growth in the region. Now, the audience question on how do you play this? How do you play digital banks? I think in Asia, digital banks are just banks. So I think if you look at a DBS or a UOB, where you have had years of very significant investment in the digital infrastructure, they offer the same sort of quality of service as some of the European purely digital banks. So I think that's one of the key ways to look at it. So these banks are expanding their market reach, they're expanding their addressable market. So I think the way to really play it is with the conventional banks.
Fantastic, thank you. Weiren, I'm going to ask you, bring in one of these other questions. I'm going to ask you a little bit about performance trends in the ETFs and try and rope in Lee's question here on do you think now is the right time to be defensive or aggressive when it comes to investment strategies? Because I think your question we asked you previously, you mentioned about always having a diversified portfolio across all the various important thematics, which probably would, I would assume, automatically cover some of the objectives that investors look for when they're obviously trying to be defensive and aggressive at the same time. So maybe I could ask you, Weiren, have you noticed any participation or performance trends across the ETFs and the investments that iFast offer that can provide insights into that, I guess that penchant for risk on, risk off, or other interesting themes like the tokenization, the digitalization, etc., that Thilan was just talking about? If you could give us a little bit of insight into some of those performance and participation trends that you're seeing in iFast, would be great.
Yeah, if I'm just looking at what our clients are buying, so obviously a lot of themes feature in their minds. So inflation, Fed rate hikes, Russia-Ukraine war. So you see investors trying to build in a bit of inflation protection into their portfolios. But at the same time, you also see investors trying to do bottom fishing in certain markets. So China is a market that features very prominently in the minds of our investors. So if I look at some of the top ETFs that are being bought by our investors, so the Lion OCBC Hang Seng Tech ETF, so that has been a favorite this year. And that has been propelled by some investors who may see the sell-off in China tech stocks over the past year as a potential entry point for them. And Asian high-yield bonds. So I think a lot of them have been buying Asian high-yield bonds ETFs as a way for them to play the property crisis in China, and also given the very attractive yields and spreads in the markets right now. So some of them are doing bottom fishing, and China at this point is a market that provides ample opportunities for investors to do bottom fishing. Obviously, I think China has a lot of things to worry about at this point. The regulatory crackdowns, the property market crisis, And more recently, you have the COVID zero, the lockdowns, and also its relationship with Russia. That has also been called into question. But I think it's fair to say that a lot of this negative overhang has already been priced into the markets. In fact, there is extreme fear in the Chinese equity market right now, as some of our investors have rightly recognized. And with the government now shifting to more supportive policies, and also preparing to give rare concessions to the US to have full access to audits of US listed Chinese companies. I think these are potential catalysts for China to turn around its performance this year. And also on the question on whether now's the time to be aggressive or defensive, I think that's a very hard question to answer. I'll just say that I think now's the time to be selective, because there are certain challenges in each of the asset classes. In equities, obviously, there's been a lot of volatility in equity markets in recent times. And if you're going to seek shelter in fixed income, you'll realize also fixed income that there are also a unique set of challenges associated with it, especially when you buy the longer dated government bonds, which have been hammered by the prospect for more aggressive rate hikes this year. So I would say being selective in your asset allocation this year, that should be the way to approach your portfolio construction. Focus on valuations and also position your portfolios in areas that can potentially benefit in a rising interest rate environment.
You bought in, Weiren, you bought in the US and China there, and I want to get to Adrian next with a question on supply chains and global trade. But before that, I do want to take this question from the audience, from Bobby, asking panelists, how will the S&P 500 performance, i.e. weakness, going forward translate to the STI's performance? And the sub-question is, which sectors would best weather the weakness caused by inflation, slower growth, etc.? Now, everyone's welcome to chip in on this question. I'm going to kind of do something that moderators shouldn't do and attempt to answer it as well, and just basically spell out that so much of the drivers that we see these days are really driven by big sectors. So the reason the S&P 500 outpaced the STI during COVID times was because technology, particularly internet-related companies and healthcare sectors, really drove the S&P 500 up very strong, while banks, which make up the majority of the STI, were contending with the lockdowns as well as the very low interest rates. Nonetheless, they were still able to grow their loan book. But it really comes down to how the different sectors perform, and that's all depends on subsector drivers. So for the moment, obviously, the inflationary outlook has helped banks, and that has, by extension, helped the STI significantly, with banks making up 40% of the STI. While on the other side, the supply chains, not so much the region, but the supply chains across the world, the constraints have also seen investors question whether the tech cycle at the moment is currently near the top of its cycle. And given that so much of the 2022 orders were built into prices in 2021, there's been somewhat of a little bit of a repricing there in the first quarter. And I think, that's majority why STI has been outperforming S&P 500, because the STI is majority banks with very little tech, where S&P is majority tech with very little banks. So it comes down to that. In terms of correlations, the STI is most correlated to the ASEAN benchmark, not the US benchmark. And that makes sense given our very strong economic and integration, trade integration, as well as our pretty important part as a cornerstone, 25% weighting of that actual index. But if anyone would like to also add some points that I might skipped over, please share.
I think the US equity market has always been a growth-driven market. Singapore, on the other hand, has been more of a value market. So I think, as Geoff has rightly pointed out, If you expect this value outperformance to persist, then value markets like Singapore, which is very high and heavy in financials, that would be something that could potentially benefit. And we have already seen that outperformance this year, not just in Singapore, but also the broader ASEAN market. If you look at Indonesia, if you look at Thailand, so these are markets that have actually held up relatively well compared to the S&P 500. So I would say Singapore and also the broader ASEAN could be a potentially good bet this year. And also given that we are relatively insulated from what is happening in Russia, Ukraine compared to the Western economies. And we are also moving to endemic COVID. So that's something that's very different from what China is doing. So there are still opportunities in the equity space, and I think ASEAN could be something that is interesting to consider for this year.
Yeah, just maybe I'll just add. I mean, I think it's also just the defensiveness of Singapore, and I think we visibility in terms of the markets are down to days now in a way, right? I mean, given all the things that are happening globally, and I think, as you say, inflation, energy costs are some of the keys. High interest rates are all some of the keys, risks that people are watching out for. And if you look at a market like Singapore, where gearing on the STI is actually one of the lowest, you've also got very strong regional integration. So you can play the overall reopening of ASEAN through Singapore in a way. And energy actually makes a smaller proportion of the consumption basket versus a lot of the other ASEAN peers. So I think that kind of puts Singapore in a fairly strong defensive position in markets like this. And I think that'll also be one of the drivers for that sort of divergence in outperformance.
Okay, Adrian, I might get to that question now. I wanted to ask you about the resilient global trade. I mean, obviously, it's very important for our region. But last year, it was actually a shipbuilder, Jiangsu-based, Yangzijiang Shipbuilding, which was our strongest performing STI stocks last year, basically amid these record orders that it had received, particularly in container ships, amid the resilience of global trade. Now, the regional outlook suggests supply chain bottlenecks are less pronounced in Asia than they are in the rest of the world. But are there any key catalysts in your outlook for increased, decreased global trade or new supply chain issues for our part of the world, which we might not be necessarily pricing into the market just yet?
I mean, Yangzijiang's record order wins last year of over 8 billion was very much a result of a perfect storm of events. So owners needing to replace aging container ships and the push towards more fuel-efficient vessels in the form of dual-fuel vessels that use both diesel and LNG. So I'd argue that this has less to do with supply chain issues, but rather factors specific to shipping and container shipping in particular. So regarding your question on global trade and supply chain issues, clearly the Russian invasion of Ukraine has injected a substantial amount of uncertainty into the market, especially with regard to food supply, given Ukraine's position as a major exporter of various soft commodities, and also Russia with oil and gas. So the key question for me is whether this will affect Asian economies and its corporates. And the easy answer is yes. So, for example, we've already seen higher palm oil prices due to potential lack of some of the sunflower oil that's coming out of Ukraine. So these prices will eventually feed into food prices down the road. And, coming back to one of Paul's answers was, the key question then is whether some of these costs can be passed on to consumers. And of course, we can't ignore the potential for new variants of COVID, which have proven to be more infectious and lethal in the future, could lead to more supply chain issues, right? And here in Singapore, one may already have noticed building construction costs have risen materially in the past 2 years due to lack of labor, as well as a shortage of materials. Perhaps, with the opening of the Singapore-Malaysia border, some of these costs may be able to be brought down with increased labor coming in from Malaysia. And obviously, the other issue is China's dynamic zero COVID policy. Obviously, that has ramifications on some of the tech supply chains. So these are some of the things that we're looking at that could impact some of the companies we cover, like Aztec and Venture, Tech, for example, with chip shortages, etc. So there are still existing risks that could impact supply chain. But I think versus 12 months ago, versus 18 months ago, I think some of these risks have come down a little bit.
So if they've abated, Paul, could I ask you if those supply chain constraints have abated somewhat for the tech stocks, what Paul, do you think might be some of the key drivers for the technology sector in the year ahead? Some of the potential speed bumps that we've been hitting in the first quarter have seen tech stocks basically give back, in some instances up to a quarter of their gains last year. Do you have any key particular sub-drivers you're looking out for this year, Paul?
Okay, I will just narrow it down on semiconductor.
Yep.
So typical semiconductor cycle, you can count it whichever way. If you do a year on year, it's probably 18 months to 2.5 years. We think this cycle will be more elongated. It could maybe reach 3 years or even 3.5 years, we think, or guess. It's probably not much difference there. So there are several factors why the cycle is longer. Right now, there's a bit of, because of the rising prices and inventory build, so that will prolong the cycle because everyone is stocking up more. Of course, that also affects the visibility. What is the real demand? The second reason is there's been a huge amount of consolidation in the industry. I think the last count will be like 300 billion the last 3 years, or 200 billion. So as a result of that, when you consolidate, there's less options. And when we entered less options, and consolidation means you cut people, right? Cut capacity. So as a result, when you enter into this upswing, there was no excess capacity. So therefore, everyone had to build new greenfields, and that takes 2 years. 2 years if you're lucky. So that another reason to prolong the cycle. And the third reason is, China. Now semiconductor has become so strategic. Everybody wants to build a plant. So that's why we think it could last to maybe 2023. Then we are a bit wary when it comes to 2023. And that's because of the reasons we just mentioned, because everyone is overbuilding, everyone is overstocking, and all this becomes a future capacity. And we are a bit more cautious. But for this year, we think the cycle can still run for semiconductor.
That's interesting. There's also one other sector that's pretty important to our market that, in addition to semiconductors, did not have such a great start to the year, but it actually had a very strong March, and that's the REIT sector. And there is a question asking about, do you think dividend stocks and REITs will take a hit if interest rates go up by about 3% in the coming year? And I think the Fed Funds CME tool believes that expectations are for majority expectations are for around a band of 200 to 225 basis points by the end of the year. So interest rates go up maybe 2% to 3% in the coming year. The question is, why would a REIT at a 5% yield be interesting to a fixed deposit rate of 3%? A very good question. You only have to go back to 2019, I think, and we had average 10-year yields at 2.15%, but the same year did see REITs in Singapore at least put on a 20% gain that year. So obviously it's not all about interest rates, and I think a number of real estate investment trusts here do have fixed rates. I think up to a quarter of the book is actually in fixed or hedged interest rates. And as we saw last year, the REITs also have a growth aspect to them. And I think it's about 20, almost half of our REITs that are listed here actually did make acquisitions with those deals having a value of close to 12 billion Sing dollars. So that's a good question. Does anyone want to weigh in on the outlook for REITs amidst the higher interest rates? If not, I'll assume we've answered it there. The next question, I do really want to get back to this what we were talking about 2 questions ago about Ukraine. Weiren, if we could ask you about basically the Ukraine crisis, and I think it was the 24th of February when the Russian president commenced military action in the Ukraine. Oil prices then rose spectacularly. They went up to very close to Brent crude went up to very close to $140 a barrel. Back obviously later this week, late this week, closer to $100 a barrel. But where do you see the oil prices heading this year, Weiren, and beyond? I think one thing you can probably count on is more volatility, right?
Definitely. But I think the general trend is that I think oil prices are going to stay higher for much longer. So the geopolitical crisis has obviously been the main driving force behind the higher oil prices we have seen in recent times. But there are also other factors that will likely keep oil prices high in the years ahead. So things like ESG. So the oil industry, they usually respond to robust demand and also higher prices by investing to drill more oil. But you don't see that happening right now because of climate change, because of ESG consideration, and also growing pressures from investors to for companies to decarbonize. And even if oil companies are willing to invest to take advantage of higher prices, it will also take several years before this new production, before production can be ramped up meaningfully. So in the next few years, I think supply is going to remain tight. And on the demand side of things, I think we still depend a lot on fossil fuels for our energy needs. There is not enough investments in renewable energy at this point to completely replace fossil fuels. So this transition to cleaner energy, while it is necessary, I think it is still going to take some time. And I think the world is still going to need a lot of fossil fuels for the long time. And I think oil prices also will remain high, even if we have a peace deal or a treaty between Russia and Ukraine right now, because I don't think Europe is ever going to go back to Russia for its energy supply because of what has happened. And for anyone else who wants to buy Russian oil at this point, it now comes with reputational risk, because you will be accused of financing war and violence. So I think all these factors come together, not just whatever that is happening in Russia and Ukraine right now. So all these things are going to come together to push up prices. And I think oil prices are going to stay higher for much longer.
Thilan, could I ask you about, go back to our big mega sector, the banks. They've previously increased allowances when we've had times of very low oil prices. Does higher oil prices impact the outlook for their business in 2022, or more oil price volatility, as Weiren was mentioning?
Yeah, so I mean, a lot of that allowances were for the offshore and marine sector, which got badly hit in the last cycle. I think a lot of these exposures are now fully provisioned. So I think the higher oil prices might lead to some write-backs and upgrades coming through the rest of the year. So that's something to kind of watch out for. But I think the sort of volatility of the overall commodity cycle and oil in general as well will impact trade finance as well as margin finance segments for the banks. So that's also something to kind of watch out for. So net, I would say you might, on the positive side, you might have some little bit of write backs, but on the negative side, you might see some more volatility in their trading income.
Fantastic. We're coming to an end. We've answered 4 of the top 5 questions. There's one more, and it's a question from each of the speakers. Which sector do you think is a must-have in a portfolio for this year? And given we've got 2 minutes left, maybe if you could take 30 seconds each, very similar to the first questions we had in terms of which sector, if you could sum it up, which sector you focus on mostly, and what your prognosis is for the year ahead. Is it a must-have? If we could start, Paul, Thilan, Weiren, and then Adrian, it would be great.
Okay, just a quick one. I guess the STI itself, I think 3/4 of the index components have some tailwinds, like banks and exchanges. 50%. So you just ride on the interest rate cycle, and the rest is just reopening. That's unique, especially for Singapore. Thanks.
Thank you. Thilan?
I think it's not about sectors. It's very much about stock picking. And I think I would buy two buckets. One is defensive, buy companies that have very strong competitive moats as well as earnings visibility. And then also companies with structural growth. So they're tied to a theme such as ESG or digitalization or emerging market consumption. So I think those are the two buckets that I would be buying.
It's very interesting. Weiren?
I'll go with China for my preferred market to play this year, because if policy was the reason why China has underperformed over the past year, then policy will be the reason why China can outperform this year.
Interesting. Our China ETF on the China government bonds saw the most inflows across all the ETFs in March. Adrian, if you could have the last words on your sector, it would be much appreciated.
Well, I think the standout for me will probably likely be Sembcorp Industries. It's a company that's transforming itself from brown to green energy. I think the ESG tailwinds will be very powerful there. So potential for multiple expansion is very, very high in my view.
That's brilliant. All right, we've come to 11 o'clock. Thank you so much for your time, and thank you so much for our audience and the questions. And we look forward to seeing you again next year. Thank you. If everyone could turn off now, it'd be great. Thank you very much.
Thank you.
Thanks, Geoff. And thank you also to our esteemed panel of experts, to our audiences who are watching us online via FB Live. Thank you for joining us. We have come to the end of this morning's streaming on Facebook. Please do join us at the main event site by registering at sgtradingfestival.com.